Hello and welcome to the WARR Quarterly Market Update. Today I'm joined by Steve Garth, a member of our investment committee. Now, Steve, looking back over the past year, it's really been a year shaped by two different factors. We've seen in the first half a lot of talk about Trump's tariffs and potential trade wars, wreak havoc on markets in the first half of the year. But once concerns really eased on that front, we saw markets shift their focus back towards inflation, interest rates, and of course, some of the valuations, particularly in the AI sector. So on that note, how have Australian and US markets performed over the past 12 months, and particularly this last quarter?
Yeah, thanks, Matt. Well, when we look at the chart of the day-by-day behaviour of the ASX 300 here in Australia and the S&P 500 in the US, you can certainly see what you were talking about. See that big dip in April, that's when tariffs were announced. Then tariffs were put on pause. Markets just took off for most of the year. Right up until October, the markets around the world, including Australia, were hitting new highs. And then the wobbles kicked in November for the very reasons you said. People were worried about stretched valuations in the US, over-exuberance around AI, sticky inflation. But the Federal Reserve did cut interest rates and the American market sort of continued to take off. In Australia, however, we had an unexpectedly high inflation print, and that really gave the market the wobbles. And you can see that big dispersion between the US and Australia. So overall, a negative quarter for Australia, but not a bad year, 10.3%. And in the US, again, another amazing year in the US, up near 18% for a US investor over the course of the year.
Great, Steve. Now, we've touched on equity markets. So for clients with an exposure to fixed interest, have we seen a similar story in bond markets?
Actually, an amazingly similar story. When you look at the chart here, it actually kind of replicates what we saw in equities. In other words, the two markets, we're showing the US 10-year bond yields and Australian 10-year bond yields, but you see they're highly correlated for most of the year. In fact, they have been for years. But now we're seeing this dispersion between the two yields. Now, when bond yields go up, bond prices go down. So no surprise, Matt, that in the quarter where Australian yields have really shot up, it's been a negative quarter for Australian bonds, an okay year. But again, for global bonds, which are mainly made up out of US yields, then that's quite a good year, up 4.7%.
Great. So it seems like the key driver between the divergence between Australian and US markets across the board really is that outlook on interest rates between the two economies. So it'd be great to touch on a little bit more what's driving the difference between the Australian and US markets.
Yeah, that is a great point. And when you look at the chart here, we're showing the path of interest rates since 2021. Now, way back in 2021, interest rates were zero. US shot up faster and higher than Australia. So it's probably no surprise that we're a little bit slower in coming back down. Right about now, interest rates between the two countries are about the same. But the reason for that divergence we're seeing is what the bond market are pricing in for the expectations around interest rates. So in Australia, they're saying there are going to be no more interest rate cuts. Interest rates will be flat throughout 2026, with the next move likely to be up. On the other hand, in the US, the market's still pricing in another cut this year and perhaps a cut next year as well. So that's the reason for that divergence in both bond yields, but also the equity markets.
Great, thanks for that, Steve. Now, for a client in a typical diversified portfolio, we've touched on Australian and US markets. It'd be great to see how other developed countries have performed over the last 12 months as well.
So it's been really another great year for investors in diversified portfolios. In the chart here, we're showing Australia, which we saw earlier, up 10.3%, fantastic. But then you look at the developed markets, this is in Aussie dollar terms, up 12.5%, much higher than the long-term average. And then emerging markets, which have been laggards for a few years, they've now really hit their straps, up 24%. So overall, where you've got those three asset classes in your growth part of the portfolio, it's been an absolutely sensational year.
So on that note, I think it's a perfect time to pause on the importance of staying disciplined, but also holding a very well-diversified portfolio across different sectors and regions to ensure we capture those returns on offer whilst managing volatility along the way. So as always, if you have any questions, feel free to reach out to myself or one of the advisors here at WARR. Thank you for watching. We look forward to seeing you next time.